Hi, guys. Welcome to the How I Raise a Podcast, the show where we get an inside, unfiltered look at how real entrepreneurs and VCs raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with Lloyd Danzig of Sharp Alpha, a venture fund that invests in sports, gaming, and entertainment startups. In this episode, we talk about raising his second venture fund and how it was quite different than raising the first-time fund, how to set up SPVs for LPs as a way to gauge interest and conviction, his 6-step funnel process to move LPs towards a close, and much more. If you're tuning into this podcast to learn how to raise capital for your business, be sure to check out Foundersuite.com if you're a startup or Fundingstack.com if you are a VC or advisor. Both platforms will give you access to an awesome collection of tools for fundraising, including a massive investor database, a CRM to manage your raise, a virtual data room to run due diligence, plus pitch deck hosting, investor updates, email tools, and much more. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Lloyd.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite.com and Fundingstack.com. Today I have Lloyd Danzig of Sharp Alpha coming to us from New York. How's your day going?
My day's going great. I'm glad to make this happen. Big fan of the pod and happy to be here. Appreciate you having me.
Cool. Let's get right to it. What is Sharp Alpha?
We are a venture capital firm. We specialize in sports, gaming, entertainment, anything under the umbrella that I like to refer to as competitive entertainment, which we define as any form of entertainment where winning matters, where outcomes matter, where the utility is derived from rooting on something, and where hopefully you're leaning forward a bit in your chair and having your attention captured.
I like that. Competitive entertainment. I've never thought of that as a category, but it totally makes sense when you say it. That's fun. That's fun. So talk a little bit more about some of the companies. Maybe give a few examples. What are some fun companies you guys have invested in?
Sure. So for any Formula One fans out there, there is a new completely free to air Formula One streaming channel. It's available on Amazon Freevee, Samsung TV, and Pluto TV now, many others soon. If you have ever watched that channel, you are actually watching on the backs of one of our recent investments, a company called C15 Studio. They work directly with the biggest sports leagues in the world to manage, operate, monetize, and distribute many of their streaming channels. So Formula One uploads all the content to C15 Studio. C15 Studio spins it up into a 24-hour channel. They distribute it to the Samsung TVs and the Pluto TVs of the world. They sell all the advertising on behalf of Formula One, and they receive a share of that revenue for all of their hard work. So that's one we are very excited about, and there will be probably a phase 2 where you see them start adding some various interactive features and on-screen overlays. Another deal we announced recently with the Andreessen Horowitz Gaming Fund is called Link, L-I-N-Q. That is a fintech and payment infrastructure company for the largest game publishers in the world. If you are a game publisher with billions of downloads, tens of millions of daily active users across 180 countries and 50 states, and you want to very quickly tomorrow turn on in-app purchases, the ability to pay money to skip a level, the ability to put in money against an opponent and have the winner of that money be the person who scores more points. It's very hard to do in any one jurisdiction. It is especially hard to do in 180 different jurisdictions that have different payment, wallet, cash in, cash out, KYC, AML requirements. Yeah. So having a turnkey solution for that is quite compelling. And one more that I'll just mention for now, but could go on and talk about many other great companies as much as you would like. For anyone who enjoys buying lottery tickets but hates the very archaic process of driving to a store, paying in cash for a paper ticket that you need to keep custody of and may be worth hundreds of millions of dollars one day. We are invested with frankly, most of the sports world in a company called jackpot.com that allows you to buy official state lottery tickets from the comfort of your desktop or mobile device. So those are 3 deals that we've talked about or announced recently. As you can see, they're all in this competitive entertainment category. We do both B2B and B2C. And I'll stop there for now, but certainly can later on go into as many more companies as you guys would like. Most of our portfolio is listed on our website.
I actually like going in buying a lottery ticket. I only play when the jackpot gets like over a billion or whatever, right? And then I'm like, all right, got to go throw $20 down on this. But there's something to that ritual of like getting the paper ticket. Now, on the flip side, though, I have purchased lottery tickets and then put them in the glove box and forgot about them, and then come back a few months later and like, oh, tickets expired. I'm like, oh, okay, that's
One of the things that I think is most interesting about what you said is you are like, I would say, the majority of lottery ticket purchasers, where it's not really your primary form of entertainment, but when it's over $1 billion, usually is most people's threshold, they got to go buy a ticket. There's usually news stories about it. You can't escape it. And so one of the things that we did think would happen when we made this investment was that, well, obviously, and completely analog retail business will eventually be digitized just like any other part of the world. What we did not expect, but honestly makes so much sense and is so obvious in retrospect, is that what would happen is once you started to be able to buy lottery tickets online and they were easier to buy, more people bought them, which means the jackpots got larger faster, which means they reached $1 billion more frequently, which then is the best advertisement for new customers to buy lottery tickets. And so that's why 6 of the 8 largest lottery jackpots ever paid in history have all been paid over the last 24 months because companies like jackpot.com and some of their competitors have really transformed it into a digital process that facilitates more sales, which facilitates higher jackpots, which are the best possible advertisement for additional sales. So we have been quite pleasantly surprised with the power of that flywheel since these online lottery businesses have gotten popular over the last couple of years.
that makes sense. How much of your thesis is focused on sports or no, not sports, but betting or gambling related businesses?
There are some positives and negatives to allocating to gambling or gambling related businesses. It's an extremely regulatorily burdensome industry. DraftKings pays tens of millions of dollars to each state that they operate in. Plus, in some states like New York, for example, you pay 50% of your gross revenue right off the top to the state government just for the pleasure of operating a casino or sports book. And so you truly are starting at, 50% of what you would having generated the same transaction volume in any other business. DraftKings, FanDuel, and similar companies are absolutely massive players. They have economies of scale that are very hard to compete with. There are very strong barriers to entry. I think most savvy investors are not looking to make investments on the B2C side that directly compete with the FanDuels and DraftKings of the world for market share. But there's a great deal of interest in many of the B2B services, the picks and shovels, the ancillary infrastructure, media companies that are partially betting and gaming focused, but also focus elsewhere. It turns out that for most customers that DraftKings cares about, betting is an entertainment activity. People psychologically classify their deposits as entertainment expenses, not as capital investment from which to earn an ROI. It's a very entertainment-focused business. And so what we have found is, we believe in competitive entertainment because we think when people have skin in the game and when people are rooting for outcomes, that is where they are both willing to pay the most money and receive the most enjoyment through non-financial features in return. Betting is a very sticky product. It is a very highly retentive product. It is a very engaging product. So there are also some pros. So we will have appetite for things that are in and adjacent to real money gaming. We don't really invest in consumer-facing sports books or casinos directly, but we do invest in media companies and technology companies that are some of their service providers and that also don't expose us to quite the same degrees of regulatory risk. But it's a burgeoning industry. The US has been one where sports betting has gotten quite popular, as certainly any sports fans have noticed over the last 6 years. And that same process is unfolding right now in Brazil for the first time, and in some of the other most popular regions of the world that are becoming more secular, more progressive, more technologically enabled. So from a pure TAM perspective, real money gaming is definitely one of the areas with the strongest secular tailwinds and expected built-in year-over-year revenue growth over, call it, the next 5 to 10 years.
Totally. While we're on this topic, then I want to actually go back in time a little bit, but what are some of the more exciting categories and trends that you see, awesome startup opportunities in?
I'm going to give you a total non-answer, but I hope it is a good insight into how we think. And I don't want to say that all VCs are like us, but I definitely think at least some people do feel this way, even if they don't articulate it. if I was smart enough to know exactly what trends were most investable, I would just incubate or build companies, in those spaces myself. We have beliefs about the value of competitive entertainment. We have connectivity and insight into how key decision makers in the world of sports, gaming, and entertainment are thinking about important trends, important upcoming decisions, important regulatory ideas, and joint ventures and things like that. But beyond that, we look for entrepreneurs who tell us what the next trend is going to be and why they are uniquely positioned to understand that trend and to execute on it. Before we met C15 Studio, for example, we were not really looking at the specific subcategory of streaming channels called fast channels, and especially the intersection of fast channels and sports leagues. But the guys who founded that company, they've been living, breathing, eating, and sleeping fast channels since that term was invented a few years ago. And
what does fast channels mean?
So there are many different types of streaming channels. Netflix is a channel that would be described as SVOD, S-V-O-D, which stands for Subscription Video on Demand. That is what Netflix, Hulu, Disney Plus, et cetera are. Those products also typically offer a package that is referred to as AVOD, advertising subsidized or advertising powered video on demand. Again, you're watching Hulu, maybe you're not paying for the subscription, but you watch ads during it. All of the content still, though, is on demand. FAST is the third category. It stands for free ad-supported streaming television. And the best way to think about it is that it is like good old-fashioned linear television with channels and a TV guide, but through your streaming device. So there's a Formula One channel. You use your Roku, not your cable box. There's no on-demand content. Whatever is on the Formula One channel, when you flip to the channel, just like the good old days, that is what's on for that particular channel. And they sell advertising throughout. And one of the reasons advertisers like it is because on linear television, everyone sees the same commercial. But that very same piece of content delivered through streaming allows advertisers to buy that ad space programmatically. So they'll usually pay about twice the CPM rate for the same ad spot delivered via streaming, since that ad can be targeted, as they would for a generic linear TV ad buy, since that is likely to see a whole number of people who are not in their target audience.
Got it. Cool. Very interesting. Let's talk about, I'm looking at your portfolio. What the hell is Slam Ball? I've never even heard of this, but it looks insane.
So Slam Ball came to prominence and popularity really in 2000, 2001, which I guess, especially if you have some young post-college listeners here, is going to seem like the Stone Ages. But it was very popular. If people remember, like the channel Spike TV, very like men's focused extreme sport channel, that had Slam Ball. And at the time, it was a trampoline basketball, I don't want to say league. It was more like WWE, WWF, where it was kind of like single events. It wasn't scripted or anything like that, but it was sort of these standalone events, one-off. You'd put a bunch of trampolines, you'd build them into the floor, you'd maybe do it somewhere on the beach in LA, and you'd get some people to come, and it would go out on Spike TV. That company was dormant for a while. The people who founded it actually were the producers of The Last Dance on Netflix a couple years ago, the Michael Jordan 90s Bulls documentary. They are media guys. And then more recently, I think we're currently in sort of a golden era for new and emerging sports leagues. We get pitched on a new sports league, at least every week, if not more often. The media dollars are so coveted. Everyone wants to create a new league and have that stream of rights. And we got together with a group of other investors, most of which are all a lot more famous than us, certainly. Michael Rubin and David Edelman and Roger Ehrenberg and David Blitzer and guys like that. And Blake Griffin on the NBA side. And we worked with the original founder and CEO of Slam Ball, Mason, from 2000, 2001, and said, we want to relaunch this, but you got to be our guy. We're not trying to bring some other CEO in. We want it to be the original blood. And compared to other emerging sports leagues, what Slam Ball had or has is, first of all, a content library of thousands of hours of footage from sort of the first time that the league was in operation. And maybe more importantly, they have this incredible nostalgia-laden, built-in audience or brand affinity. When we did the first Slam Ball game last summer, and by the way, Slam Ball got an exclusive 2-year deal to broadcast every one of their games with ESPN. their first year of operations. Anyone who's tried to start a sports league and monetize their rights will tell you how rare and nearly impossible that is. And the first game we did in Las Vegas last year, you can go, look it up yourselves. Patrick Mahomes, all these A-list athletes are tweeting completely free. It wasn't paid. They remembered slam ball. They're tweeting, bring back slam ball. We love slam ball. Can we bet on slam ball? And that type of organic awareness was really a leg up on many of the other emerging companies. Now, I will say software investors usually don't have appetite for leagues, which basically are media companies in terms of their margin and return profiles. And we do see some technology investors who just won't spring for it. To them, one thing we would advocate is that having a league or a media company that has that kind of visibility is one of the best assets you could ever plug your other portfolio companies into. And so we have 2 media assets in our portfolio among a broader portfolio of maybe 30 tech assets. But those 2 media assets are partnered with, synergistic with almost every technology company in our portfolio in ways that are quite accretive to both. But that's Slamball. Stay tuned for an announcement about their season 2 that I think should be coming out not too long from now. And feel free to check out some of their highlights. We're big believers that the best sports are very highlight driven and lend themselves to highlights. And there's nothing more fun than someone, doing a quadruple backflip alley-oop into a crowd of madness beneath from behind the 3-point line.
I've never seen it, but I have to. After this, I'll check it out. I love their tagline, where basketball and football cultures collide, and the images are of, basketball-looking players with kind of quasi helmets, pads. And it looks
the hits are big. We had Marshawn Lynch in the broadcast booth for the championship last summer, and some of he's hilarious and obviously a character, and some of his clips of him taking in the game for the first time were some of the best content. But yeah, check it out. A quick slam ball highlight clip reel. You'll probably go down a whole rabbit hole, find yourself watching some legacy footage from the late 90s. It's a good time. It's an easy watch, and it's fun to share with your friends.
Totally. All right, one last question, then we'll get into raising capital for your fund, which is the core theme. But what's the backstory? Do you have a quick backstory? Like, why'd you decide to launch this fund?
I don't know if I have a quick backstory that is also a reason why I decided to launch the fund. I've always loved sports and gaming. I've been a fantasy football commissioner for as long as I can remember. I was a bookie in high school briefly. And by bookie, I just mean guy who had a spreadsheet and collected money from their friends over Venmo, but really gave me an appreciation for the business side of sports and gaming and betting and lottery, casino and things like that. I spent most of my career in more traditional finance. I worked on Wall Street at BlackRock. I was at a smaller shop where I was a fixed income trader for a while. In 2018, that's when sports betting was legalized in the US. And having grown up just surrounded by a social circle that is almost 100% filled with people who love betting on sports and anything and everything, I had a sense that it was going to be a bigger industry than people even realized. So I was involved in helping to set up a company in New York called SimpleBet, which provides data, odds, and infrastructure to many of the biggest sports books. If you've ever, or your audience has ever engaged in something that is now called micro betting, will the next pitch be a ball or a strike? Will LeBron make or miss his next foul shot? That was all invented by and is all powered by SimpleBet, which now you can see if you do a quick Google search. It is rumored that DraftKings is closing on an acquisition of them. DraftKings already owns 15% of the company, and it has been rumored for a couple of months now that they are closing out in an effort to vertically integrate the remainder of that business. And so having spent a little time there, that was the eye-opener that made me appreciate, frankly, how archaic and riddled with technical debt all of the infrastructure is that supports this competitive entertainment ecosystem. So from there, I started doing just a little bit of angel investing here and there. I think the first angel investment I ever did in this space was like $5,000 through an angel list syndicate. And of course, kind of built up from there and started getting some advisory roles and some board roles and had a few that went well. And then just having come from a Wall Street background and being in New York, had people who said, hey, we'd love to put some of our money into these cool deals that you're doing that seem successful. And that was sort of the catalyst for Fund One, which was kind of a proof of concept fund, mostly friends and family, high net worth individuals kind of folks. That was a few years ago. We're now in a different place where we've now closed our second fund and have much more institutional investors and publicly traded companies and foundations and endowments and things like that. But none of it was deliberate, but that is roughly the origin story, if you will. I am definitely a power user of any product that we ever investigate, and our whole team. Anyone on our team that you talk to is a hardcore power user, loves games, loves video games, loves betting, loves sports, loves competition, loves rivalry, and that we really think that helps us evaluate new product ideas.
Interesting. All right, let's talk about raising money. So you guys you just fairly recently raised Fund 2, but how much have you guys raised total? And I guess, is it over 2 funds?
Sure. Yeah. So we announced that we raised a $10 million Fund 1. And then we announced more recently that we also closed a $25 million, or I think we announced that it was oversubscribed at 25, Fund 2. We also have raised additional capital beyond that. And we've done a number of SPVs that are only for our investors that would take our total AUM quite a bit higher than that. But that's all we've announced so far. So that's what I'll leave us with here just for now.
So yeah, maybe talk about the difference between raising that Fund 1 versus Fund 2. I know it's different eras in some ways, 2021 versus 2024, but also, just talk us through it. Talk about raising.
Yeah, raising for a fund is tough. I think it's much harder, frankly, than raising for a company, especially as a first-time manager if you're not, spinning out of a tier one. And I think part of the reason is, well, the fund has a longer lockup period. It's a lot more opaque. And more specifically, when you're a founder of a company, at least you can say, hey, I'm going to build widgets for $1 and I'm going to sell them for $2. And here's my evidence. As a fund, you're kind of saying, hey, trust me with this capital. I'll make a bunch of investments that you don't have any visibility into at the moment. Your money will be locked up for 8 to 10 years, and hopefully you get a nice multiple of it back at the end. Now, obviously, that's not how I phrase the pitch when I give it, but almost by implication, that is kind of what you are saying, especially as a first-time manager, and it's just a much harder sales pitch than it is for a specific company. Raising for a fund also usually takes longer, and what anyone who has raised money will know is that if you lose that sense of urgency and motivation among your investors when you first go out to market, it's almost impossible to ever get it back again. I think startups have a slight advantage in that you say, hey, we're raising $3 million. The round closes 3 weeks from now. Get your commitments in before then, and we'll let you know if we can fulfill them. It's a little easier to let people slip into tomorrow and tomorrow and tomorrow, I think, when you're raising a fund over a longer period. With respect to 2021 versus now, it's interesting. 2021 will probably be one of the worst vintages for venture capital ever. 2024 will probably be one of the best vintages for venture capital ever. Interesting, a lot of family offices and LPs will say things like, it was very easy for us to invest in venture capital in 21, and it's very hard for us to invest today. And to me, that's just a classic example of a Buffett, be greedy when others are fearful kind of mentality. And a lot of people in VC will say things like, they will look back on their careers and they will say, when it was easy and felt good to be investing, that was actually the bad time. When it was hard and felt painful to invest, that was actually the good time. 2021 definitely felt good. Everything was easy. Every round you invested in, you thought it would be marked up 6 months later. And in retrospect, that ease also corresponded to ease of capital deployment and inflation and asset valuations across the market. And similarly now, where some folks are finding it harder to allocate is why it's the best time, why the investor friendliness pendulum has really swung away from founder friendliness. When I look at 21 and raising our first fund, what I notice is an incredibly high percentage of people responded to our outreach or agreed to set up an initial call or have an initial conversation. But the conversion rate was on the lower side. This time around, much fewer people took the initial calls, but a much higher percentage of people ended up investing. And I think the reason for that, even if you adjust for us having experience and a reputation and a track record, is that in 2021, anyone, even who didn't know what venture capital was or have any understanding of the asset class, thought it was a hot space, was willing to take at least a fly or take a quick call, see what these people had to say. In the current market, most people who aren't actively trying to allocate to a venture capital fund, they're not even going to respond to your email in the first place if that is not a very serious consideration. And so I think that's why we've observed, a lower rate of maybe total meetings, but a higher conversion rate among those meetings, because I think fewer investors are taking these kind of like arbitrary prospecting calls these days. Though that honestly is the biggest difference. And then the other just obvious difference is capital was flowing in 21 in a way it is not now. And when you're talking to foundation and endowments, that's one thing, because they usually do have a specific, venture capital private equity bucket they have to fulfill. But when you're talking to a random rich guy, or not random, all of our LPs are very strategic. I don't mean to describe them as random, but when you're just talking to someone who has made a lot of money doing something else, they can do anything they want with that money, including not invest it at all, including buying a boat or a plane or going on vacation. Sure. And now they can put their money in treasury bills, completely liquid at a risk-free 5% interest rate, or they can go a little out on the risk curve and probably get 8 to 9% interest, relatively risk-free. That was not the case in 2021. In 2021, your only alternative was to basically keep your money in cash under the mattress and not watch it appreciate. So I think whether you're a founder, you're a fund manager, no matter what, if you are talking to people who don't have a specific mandate, they can easily decide to just not make any investments at all if they want, or leave their money in a CD account or treasury bills. You got to know that that's a real major factor in opportunity cost that non-institutional investors, I think, are weighing very heavily now. And I think it's one of the reasons one of the many reasons a lot of startups are finding it, quite difficult to raise in the current market.
Let's talk about the actual process. And I guess let's stick with this most recent fund, since that's fresh, but talk about how you had fund one. I'm sure you had some good portfolio companies that got marked up and had some good traction. Now it's time to go out and do fund two. How did you identify target LPs? How did you get in touch with them? How did you, get into the weeds on the process?
Yeah. So it is very hot right now for larger asset management firms to want to try to take GP stakes in emerging managers across venture capital, private equity, and hedge funds. It's an interesting strategy because it provides you both the current income of your pro rata share of annual excess management fees, but also a larger distribution through your carried interest. Whereas a traditional LP investment in a fund, you're not getting any current income. You're only getting, the capital gains at the end. And so we have seen quite a bit of that, and we've received some very attractive offers. People who say, hey, we'll take, 40% of your fund, 50, 60% of your fund. We'll give you office space. We'll give you this. We'll give you a parking spot. We'll give you that. But in return, we want this voting power. We want veto power over that. We want this percentage of all the management fees you generate. We want this percentage of all the carried interest that you generate. So we have so far abstained from many of these offers, but that is something that if you're a good fund manager, you hopefully have available to you, is especially after fund one, the ability to find someone who wants to take a piece of your whole business and will do a lot of the capital raising. And no different from a startup. You're trying to raise $50 million. It is much easier when you tell people we already have 40 committed than when you ask someone to be the first dollar in. So for many folks, although not us, an anchor LP or a GP investor or someone who is both, sort of the equivalent of a lead investor in a startup round, is a certainly helpful de-risking element. For us, I don't want to say luckily, because a lot of it was hard work, but I don't think it would have been possible had we not done a really great job with Fund One, made our LPs really happy, and had almost all of them resubscribe into Fund Two. One of our LPs increased 10x their commitment from Fund One into Two, and we had others who increased similarly. So we did not go out to any new investors until we had a very significant chunk of the fund already committed from our existing investors. Because just like with a startup where your Series B prospects ask who were the Series A investors and are they participating now, the same goes for a fund. A new LP sees a smart investor who was in your first fund and who has plenty of capital to deploy. They will take a very strong signal, positive or negative, from whether that LP is re-upping into Fund Two. And institutional LPs, especially with 30, 50, 70, 100-year time horizons, they look to invest in a fund manager and invest in several of their funds over time. We, probably not too different from others. We run a process. We build out our own CRM. We identify target investors and have many different ways of thinking through that. We are exclusively, a warm intro focused fundraiser for the most part. We try to avoid cold outreach pretty much at all costs. And, we go through our process and we do our outreach and we set up meetings and we log them in the CRM and we follow up with people who ask for materials and kind of keep that process going. We try to have a specific period where initially we're gathering interest. Then there's a period where our data room is open and we're taking commitments, and then we close on all those commitments. For a startup, you can usually do that in one shot. For a fund that often has multiple closings, we usually do it twice. That's what we did here. We got all of our Fund One investors in and then took interest from others, then took all of their commitments, closed that up, and then we went out again and took indications of interest, had a period where those people could commit took those signatures, and that was what was called our final closing. So some funds do multiple closings, some do one, some do a rolling perpetual closing. We had a first close and a final close, and we kind of operated it in that fashion.
You said pretty much only did warm intros. So how did you just tap all your investors in Fund One for those intros? How did you get warm intros? And let's talk about your LP base, because I think it's a pretty diverse set of LPs. So again, I guess I kind of asked this, but I don't know if I got a good answer. How did you identify new LP investors, and how did you get in touch with them to get them into that workflow you just described?
So first of all, who are our LPs? Our LPs in Fund 2 include some of the biggest publicly traded companies with 10 to $100 billion market caps in our sector, one of the largest U.S. financial institutions, owners of several of the professional sports teams in the U.S., some A-list athletes and adjacent celebrities, some large hospitality companies, some casino companies, some hotel groups, pretty much exclusively strategically valuable stakeholders. And it's a big part of our value prop and our pitch and how we de-risk deals, that we have a uniquely positioned LP network. And I can go into that more. How did we prospect and identify investors? I'll tell you, we did it opposite for Fund 2, the way we did it for Fund 1. The way we did it for Fund 1 is probably the way that makes sense and what everyone should do, at least as opposed to doing nothing, which is through whatever research channels you can, just make a list of the 100 top investors you could ever want. And then one by one, go to LinkedIn. Who are your mutual connections at the organization? Make a list. And then go through that list. And for each organization you want to talk to, reach out to the strongest possible connection that you can think of and say, hey, do you have an introduction? I can send you an easily forwardable email, whatever it is. Obviously, sometimes you got to start somewhere. For us, being involved in conferences and speaking on panels and developing relationships with fellow panelists and people who appreciated the insights that we brought to the table were probably very helpful originally. But the much more helpful thing was the 10 years I spent previously at Penn and then Columbia and then on Wall Street, always trying to, hopefully build up the right type of reputation so that when I did, need a favor or an introduction in the future, people would view me as someone who would reflect well on them, who hadn't asked for a million favors in the past that fizzled out. And so I think one of the piece of advice I would give is that, your fundraising, the best time to start fundraising is as long ago as possible, because it's really just relationship building at the end of the day. Now, for Fund 2, we kind of flipped it differently. Like, I still think that exercise is very valuable. But instead, what we do, and what I recommend if you have the network, is we first made a list of, I don't remember if it was 10 or 15 or 20 or 50, but we first made a list of our existing investors and other people very friendly to us, who we thought were the highest quality, highest caliber, best reputation, best pedigree, and who, if we asked, would be willing to really stick their neck out for us, really put extra elbow grease into making a specific introduction, and who potentially would be not just a guy that, you met at a conference once, introduction-wise, but, someone's best man from their wedding, their roommate from college. And so we start with that list. Who are the best people who are in our network? Then we say, for each of them, who are 5 or 10 people they might be able to introduce us to who are potential investors. And when we go to person 1 and say, hey, I saw you were connected to group A and group B, are those warm introductions that you can make? If they come back and say, yeah, that's just a guy I met at a conference once, but I'm happy to ping them, we say, thank you, but let me come back. Let me see if I can find a stronger entry point. And what we've found is that finding a high quality introducer who hopefully is a successful investor themselves and will reach out to people they have invested with successfully in the past, and who will go out on a limb and really talk about you in a special way that they wouldn't talk about others. To us, that is more valuable than whatever the profile of the actual investor could be. We're trying to raise, for this fund, it was $25 million. That's a very small amount of money in the scheme of capital that exists. And if you're trying to be a challenger brand, if you're not, an already anointed market leader in some capacity, we have found it is better to optimize for the strongest and highest quality possible introducer rather than the most ideal profile for the introducee.
Interesting. Okay, good. And, I don't know how many, if you can share any names, but like, you have pro sports team owners. Those are good guys. and there are a few gals I think out there too, mostly guys, but like, how do you get in touch with those folks, and what are they looking for when they're looking to invest in a fund like this? In other words, I mean, let's take that as a, a target investor profile just on its own. Like when you're pitching
I'd say there are two routes.
Yeah.
Sure. There are some people who became sports team owners because they first succeeded in technology or trading or investing or something like that. And for those folks, often we had a pre-existing relationship with them before they became team owners. And that type of relationship or investment tends to be, I don't know, something more of like an affinity or relationship related product. It's a guy who's really made it. He has tons of assets. Sure, it could be complementary to the organization, but this is someone who we know from the world of finance and who is, kind of just trying to maybe pay it forward and keep working with good quality people. The other profile are team owners and ownership groups who are thinking of establishing a family office or a venture fund. Many of the biggest and most wealthy team owners, David Blitzer, Josh Harris, they have fully staffed family offices that have real estate arms and private equity arms and fund-to-fund arms and venture capital arms. But for those that don't, if there's about 120 teams covered by 75 ownership groups, maybe the top 5 or 10 of them have, fully dedicated 10, 12 person teams internally, but the rest do not. And for those groups, they are constantly trying to look for what is the newest, latest, and greatest technology that we should be integrating into our stadium? What is the new hot brand among 22-year-olds that we should make sure to stock at the concession stand? What is the new modality on TikTok or Twitch or Instagram that we need to be in front of if we are going to engage the young audience? And there are many ways you could accomplish this as a sports team owner or organization or a league. There are groups that have accelerator incubator programs, and they invite 100 startups to apply, and they pick 5 each year, and maybe they get a couple dollars and a dinner and a proof of concept pilot with the team. But one of the best ways we have found, both for team owners and many of our strategic corporate investors, is that they put an investment into our fund. We then show them deals that we're looking at. We often give them the opportunity to put additional capital into deals that they really like and are synergistic with their commercial needs. We have one LP who we do a monthly just industry intelligence call with. And frankly, they probably care more about that than the financial returns to some degree. And so I think the answer is, look, we're a $25-50 million fund. I'm not going to make a billionaire much richer, even with the best possible outcome for that fund. So to your point, what does a team owner worth billions or tens of billions of dollars get from an investment like this? I'd say the same thing as a $50 billion publicly traded company. What do they get from an investment in a fund like ours? Well, we are specialty and dedicated. We see all the best deals and the best founders in their space. If you're a corporate development executive at a big public company, your job is to find startups, find investment opportunities, find M&A opportunities. And so we find that strategic angle has been very helpful to us in getting strategic LPs on board. From there, the step that we take is, well, now every time we evaluate a deal, if we evaluate a company that has a new software for sports stadiums, for example, we don't try to do guesswork. We introduce them directly to a bunch of team owners. And if those people become customers, we know that they're onto something. And so because we have this really major, let's say, de-risking capability where we're not going to invest unless essentially one of our LPs is becoming a multi-million-dollar customer, that is what helped us then attract some non-corporate but very prestigious LPs who say, wait, you mean I could put my money in and effectively, like, we're getting into deals at a discount and we're investing alongside major commercial relationships that the rest of the market is not aware of and that de-risk the business. That sounds like a great value proposition for a non-strategic LP who generally wouldn't get access to terms like that. And so that laddering, Fund 1 LPs, leveraged into getting more strategic corporate LPs, and then leveraging that into getting a few more financially motivated non-corporate LPs, was, for us in this particular time, in this particular market, the recipe that worked quite well.
That's interesting. Yeah, that's a good way to think about your capital stack, I guess you could say. And I know you don't want to name names, but how do you sort of break it out if you have this data top of mind in terms of like portfolio construction between, say, family offices, financial institutions, strategics, or I don't know,
I would
Do you have
say
kind of a sense of that?
on a dollar weighted basis, strategic corporates are probably our largest pool, followed by some tie between family offices, foundations, and fund of funds. Those three groups together might be more than the corporates if you combine them. But the strategic corporates are our biggest investors. And then, the team owners / family offices, the foundations, and a few fund of funds. Those are probably, all tied for next.
And Fund One, was that mostly family offices and high net worth people, or did you have a couple strategics in that?
We had small strategic, a couple of family offices, mostly high net worth individuals, inclusive of, and some people call these strategics, industry CEOs. We didn't get balance sheet investments until Fund Two. We did a great job getting many of the CEOs, CTOs, CFOs, CIOs of the companies into Fund One. And fortunately, some of those guys then graduated to having, seven-figure investments made directly off the balance sheet of their organization, which brings a lot of, if nothing else, diligence-related credibility to the table. I will tell you, going through a diligence process on 200 pages worth of docs with a Japan-based publicly traded company, talk about attention to detail. Those guys deserve an A+ for it, but we definitely paid for it in billable hours. But as soon as that was the case, the next 5 LPs we brought on were like, oh, we don't even have to look at the docs. Those guys did it. We're quite sure they had a more robust level of diligence than we would. So double-edged sword, but getting some big publicly traded corporates on board was a major positive signal, I think, for future LPs.
Won't keep you too much longer. In our pre-call notes, you had a bullet that was the importance of investor psychology and consumer psychology. And I don't know how to frame that exactly in a question, but do you want to tackle that in the context of raising?
I don't honestly remember what specifically I was thinking of when I wrote that bullet point, but they are both topics I think about all the time. We take a very anthropological view. The reason we like competitive entertainment, not that you or your viewers asked, but we believe at the base level of humanity in a couple of things. We believe that value is created in the mind, that perceived value is real value, and that incentives govern all. That's kind of our base layer of axioms. And on top of that, we observe, first of all, that purpose and connection are the two most fundamental human needs, and that attention is our scarcest and most valuable resource. And we put those two things together when we say, what are the activities that capture our attention and deliver to us a sense of purpose and connection? The first two examples we think of, well, categorically, we think of experiences where you have skin in the game. Specifically, we think of sports and gaming. If you're a sports fan, if you're a video gamer, what have you actually gotten for all the money you've spent? I would argue you had, when you go to a sporting event or you play a video game, you get a sense of purpose for the next few hours. You care about winning, about who wins, about what the outcome is. You get a sense of connection, the person you went to the game with, the person who bought the tickets for you, the people you reminisce with about the game later on, the people who you catch up with. You just see you're the same. You're the fan of the same team as they are, or maybe of their rival. And again, it's like that money is capturing your attention and being converted into some combination of purpose and connection. And we feel that sports and gaming are two prime examples, but this competitive entertainment category is a broader umbrella that encapsulates all the best business models, which also capture people's attention and deliver them purpose and connection. So on the consumer psychology side, that's very much how we think about things. I'll leave you on this particular question with a note about investor psychology that I continue to find so interesting, especially as I deal with more and more sophisticated and accomplished and pedigreed investors. I might have mentioned briefly, in addition to our fund investments, from time to time for select deals, we set up an SPV. It's only available to our LPs. It's a deal that we really like, but maybe is slightly outside of our fund strategy. And we did a bit of A/B testing. And what I noticed is that if I reach out to some LPs, even family offices who are investors in hundreds of funds, and I say to them, we are thinking about doing an SPV. Do you have any thoughts on this deal or the size of check you might be interested in? Versus going to that same LP and saying, we are doing an SPV. It's closing next week. You can have up to this much. Let us know how much you want. That same LP, looking at the same deal with the same financials, I'm not saying this is 100% the case, but I'm saying one thing I have been shocked at is how even some of the most sophisticated, intelligent, track record, pedigreed LPs in the world we have found will respond in a very muted way if we say, hey, we're thinking of doing this SPV. But for that same deal, if we say we're doing it, they'll respond and put, a significant check in. And that has just taught me that, no matter who you see on CNBC, no matter how confident anyone is, a lot of people just really can't even predict how they themselves would act in a given situation until you put them in that situation. And no matter what, no matter how fundamentally driven an investor is, we're all just humans at the end of the day, and we all have biases and sense of urgency and FOMO, and we want to be right. We avoid embarrassment. We don't want to be wrong. When someone comes to you with an SPV that they're not sure about raising, it makes you worried that you might be embarrassed for making that deal. The same person comes to you with the same deal and a ton of conviction. It's kind of like how you only get one chance to make a first impression. And I think sometimes you go to an investor and the level of confidence and certainty you have in that deal really sets the stage for how the rest of the conversations can go. So that has been one of the most interesting investor psychology insights that we have observed, along with the one I mentioned before, how we see many LPs or prospective LPs who are aware of the Warren Buffett mentality of being greedy when others are fearful, who are aware of the VC mantra that when it's hard to invest, it's good, and when it's easy to invest, it's bad, and who are still out there saying, it was easy for us to allocate to VC funds in 2020, 2021. It's just too hard for us now, so we're not going to do it anymore. And that has been, again, another interesting investor psychology insight for us.
Those are interesting. Those are all very interesting. I like that. That would be an interesting A/B test of thinking about XYZ versus this is what we're doing, and that conviction leads to more FOMO.
I wish I had the actual URL so I could send it to you to put in the show notes or something. There was a great Harvard Business School case study recently that showed that the sentiment of the language used in M&A announcements was a direct predictor of how valuable that asset would be 12 months after the announcement. We are all just humans at the end of the day. We are all susceptible to illusions, to the influence of language, to the way that emotions play upon our biases. And I think, you got to build a good company. You got to build a good fund. You got to have good numbers. You got to know your stuff. But you kind of just also have to be someone that people are excited to be around and are energized by the presence of, because I don't think you'll convince me there's a single investor in the world that truly puts 100% of their emotions and intangible desires at the door. Maybe there are guys who get up to 95, 99, but I think everyone is human at the end of the day and susceptible to various biases.
100%. All right, I will let you go, but I do have one loaded question. I play probably 3 hours of pickleball 5 to 6 days a week. So when will you make your first pickleball league investment? Or I don't even know what the format. Have you seen any cool pickleball deals? I could ask it like that.
Sure, I'll answer it like that. There are 3 types of pickleball deals, 4 types of pickleball deals that we see. Investing in a pickleball league, investing in a pickleball team, investing in a pickleball hardware and equipment and facility related company. Maybe I'll throw in another, it's kind of like a league. There are some media assets that are a little more pickleball focused. And then I'll tell you, we've seen 3 in just the last couple of weeks. Top golf for pickleball is something that everyone is trying to do. There's a particularly popular one in the South called Chicken and Pickle. It's like a fried chicken plus, pickleball outdoor territory. There's another one that we were pitched on the other day called Slice Pickleball. And that is in addition to the padel clubs and those games. So there are many ways that people are playing pickleball. We do think that at this point, a lot of the anticipation is probably priced in. It's probably tough to buy a pickleball asset at a really good price today. They're no longer an emerging league or sport. And I will be honest, although it's fun to play, I do wonder how well the game really translates to television. There are some decent pickleball highlights, but I'll watch NBA, NFL, MLB, or NHL highlights probably over pickleball any day. And I do think that is a very real consideration when trying to underwrite growth. So I think people will keep playing. I think you'll see more and more courts. I think you'll see courts in really cool, exotic locations. You'll definitely see more Top Golfs for pickleball. You'll definitely see more Top Golfs for every other sport. We just got off with Top Golf for basketball that's opening in Dallas next year. We just got off with Top Golf for soccer that's actually opening in Dallas down the street from Top Golf for basketball. This category is often referred to as eatertainment, eating and entertainment, portmanteau. And you will be hearing more from us and probably from the market in general in the coming weeks on this category.
Eatertainment. We had Putt Shack on this show.
There you go. So,
yeah,
Putt Shack, classic entertainment company. They are doing a great job. We have incredibly high regard for the management and investor group there. That's exactly right. I'm glad to hear that you had those guys here. They're great.
Cool. All right, last thing. If people want to learn more, where should we point them? URL of your website?
Look me up on LinkedIn, Lloyd Danzig, or check us out. SharpAlphaAdvisors.com is the website. SharpAlpha.vc also forwards there. You could shoot me an email, lloyd@sharpalpha.vc anytime. And if you have a deal to send us, I'll give you the clue. There's a little link at the very bottom of our website that if you find allows you to submit a deck and some other materials. But I appreciate it.
Does someone look at those? Does someone actually monitor those, or is it an intern or what? Who looks at those submissions?
They are definitely monitored, but I did just spend 30 minutes on this podcast talking about how important the warmness of a high quality intro is. So founders can take from that whether they would like to go through the website or try to find a warm intro themselves.
Yeah. Good. All right, my friend, this is pretty cool stuff. I'm going to check out some slam ball later. I'm going to go down that wormhole and check it out. So anyway, good luck. And we'll catch you after fund number 3 and see what new cool stuff you've discovered. All right.
Thanks a lot for having me. Keep up the great work.
All right. Over now. Thank you. Bye.